meeting. At the outset, I will make the usual statement which I have. Thereafter, we will take any questions or observations. And we'll try and accommodate as many questions and observations as possible. So we'll proceed accordingly. The Monetary Policy Committee reviewed the macroeconomic developments and the outlook over the course of the past 2 days, that is 2nd and 3rd April, and in its meeting today, it voted by a 4:2 majority to reduce the policy repo rate by 25 basis points and to maintain a neutral stance of monetary policy by a 5:1 majority. I thank the MPC members for bringing to the discussions their experience and erudition. I also wish to express my appreciation for our teams in the Reserve Bank for their hard work in providing high-quality inputs for NPC's deliberations. I would now like to set out the main global and domestic developments that the MPC evaluated while formulating this decision. It noted that there is a further loss of pace in global economic activity since its last meeting in February 2019. Moreover, the slowdown appears to be synchronized across advanced economies and some major market economies as well. This assessment is also reflected in the monetary policy stances of their central banks, which have either eased or paused. Inflation remains low in major advanced and emerging economies, although crude oil prices have risen on production cuts by major producers and supply disruptions among some exporters. As regards financial markets, equity markets have generally rallied. Bond yields have eased in some advanced economies and they have slipped to negative territory. In currency markets, the US dollar has traded with an appreciating bias while emerging market currencies have softened. Turning to domestic developments, the MPC observed that the Central Statistics Office CSO has pegged India's real gross domestic product GDP growth at 7% for 2018-19, down from 7.2% in its first advance estimates. More recent high-frequency indicators point to manufacturing growth slowing down while investment demand is subdued. Credit flows into micro and small as well as medium industries remains muted, though they somewhat improved for large industries. Capacity utilization in the manufacturing sector is running above its long-term average. There is also some improvement in business sentiment. High-frequency indicators of services sector such as sales of commercial vehicles and freight traffic indicate moderation in activity. The MPC also noted that CPI inflation rose to 2.6% in February 2019 after 4 months of continuous decline. The upturn reflected an increase in prices of items excluding food and fuel and weaker momentum of deflation in the food group. Households' inflation expectations declined by 40 basis points each for the 3 months ahead and for 1 year ahead horizons. Manufacturing firms reported reduction in input price pressures. On India's external front, export growth remained weak in January and February 2019, while imports, especially non-oil gold imports, declined. The trade deficit narrowed in February 2019 to its lowest level in 17 months. Net FDI inflow were, however, strong, while foreign portfolio investors turned net buyers in domestic capital market in Q4 of 2018-19. India's foreign exchange reserves were at 412.9 billion on 31st March 2019. Taking into account these developments and looking ahead, the MPC revised the path of CPI inflation downwards to 2.4% in Q4 of 18-19 2.9 to 3% in H1 of 1920, and 3.5 to 3.8% in H2 of 1920, with risks evenly balanced. GDP growth for 1920 is projected at 7.2%, 6.8 to 7.1% in H1 of 1920, and 7.3 to 7.4% in H2, with risks evenly balanced.